If you're a business owner or an executive, you need to watch out for Medicare's punch in the gut tax.
That's right. As you probably know, Medicare is not only not free, but it's actually kind of expensive, and it's going to be way more expensive for you than it is for most people. And that's because of a little thing that we like to call Medicare means testing. Not only will you have to pay more for Medicare when you retire, but you may be paying up to 3 or 4 times more than other people just because you have a higher income in retirement. Doesn't really seem fair, right? The more you've prepared for retirement, the better your planning skills, the more money that you have in retirement, the more you're gonna have to pay. It's not fair, but it is what it is. So we are here today to tell you what to do about it, how you can avoid it if you can, and if not, exactly how you can save some money on the tax side.
I know, Shannon, you're a big kickboxer, so we're going to show some moves in here about how you can avoid some of these costs, or at least minimize some of the costs. So we kind of came up with punch in the gut, or where that came from was one of our clients. Mm-hmm. He had turned 65, he was self-employed, and he'd been paying about $1,000 a month for his health care. Well, he got to deduct it on his tax return. So his net cost was closer to about, he was in a high tax bracket, in a high tax state, is about 50%. So he saved, instead of costing him $1,000, it cost him $500, which wasn't too bad for him. But when he turned 65, he had to get on Medicare Part B and Part D. Because of his income, he's in that higher tax bracket, so he's subject to means testing. Since Medicare Parts A and B and D don't cover everything, you have to have supplemental coverage. So he bought a Medicare supplement with a prescription Part D plan. So he put all that together, looked at the means testing premiums, and his cost was $650. And he said, holy cow, I thought my costs were going to go down when I retired. And now they're $650. Now, granted, that $650 is not $1,000, but again, remember, he was only paying $500 because of the tax benefit. Well, here's the first thing that people don't realize is once you're retired, you really don't get to deduct your medical premiums unless they happen to be very large and you have a lot of medical expenses. For most people, and most people in higher income brackets, they're not going to have a medical expense deduction. So that $650, he had to think about, all right, if I'm paying for this with my 401k dollars, I'm having to take $1,300 out using that same 50% tax bracket. So I got to take $1,300 out to net $650 to pay my Medicare. I mean, he was blown away. So we went from $500 to $1,300.
Yeah, and this poor guy thought he was going to be possibly saving money when he had to take Medicare.
Exactly. So that's the punch in the gut, and that's something that most people do not realize, they don't think about, and quite honestly, a lot of planners don't think about this, how this is going to occur and what those costs are going to be, because they don't know what the numbers are.
Right, and I just want to throw out there that unfortunately, Medicare doesn't always cover everything. So, you're thinking about the means testing on Parts B and D. Well, there's all these other components if you really want good coverage that you're going to have to purchase when you turn 65. And then there's also dental, there's vision, there's things like hearing aids that you might not be worried about today, but down the road, that kind of stuff isn't covered by Medicare. So that's just additional expenses. And then there's the long-term care piece, which is something that most people don't realize. Long-term care is not covered by Medicare at all. So that's going to be another expense. And you might be thinking to yourself, well, when I turn 65, I'm going to continue to work, especially a lot of entrepreneurs out there who say, it's fine, I'm going to continue to work. Maybe I have group coverage and I'll stay on that. Well, you may not be eligible. You have to work for a pretty large company to be able to keep your group coverage when you turn 65. So there's not really a choice for a lot of people.
That's exactly right. For a lot of our small business owners, self-employed individuals, and just small companies in general with less than 20 employees, this is a big issue and impacts them greatly.
Yeah.
So what can you as a business owner and executive, what can you do to help offset this punch in the gut? Well, there are ways to do it, especially if you've got time. If you're 65, obviously it's much harder to do any significant planning to alter this. But if you're younger, there's a number of things that you can do. So the first thing you want to be thinking about that a lot of people have access to are health savings accounts. Because remember, what we're trying to do is we want your income, if we can, to go below what the different brackets are for means testing. So we want to reduce your modified adjusted gross income if we can. If we can't do that, then we at least want to lessen the impact from a tax perspective. So our friend, that was paying $650, if he could be doing that with tax-free dollars, he's saving $650 a month based on his taxes.
Yeah.
We want to do both if we can. So we want to figure out how can we lower your modified adjusted gross income, but we also want to make sure that you get tax-free income when you're retired to pay for these costs. So there's a number of ways to do it. So the best way, again, health savings account, making sure that those are available. If you have a high deductible health plan, you can contribute to the health savings account. You want to make sure you max that out. Put as much money into it as you can. We see a lot of people today where they don't, even though they may have medical expenses, they don't spend the health savings account money. They let it grow, they invest it, and they make it look like their medical 401k plan or medical IRA.
Yep.
So that's one that you can do.
Yes. So the second thing that we want to talk about is really what we like to refer to as a super HSA, and that's a 401h. A 401h isn't going to be an option for everyone, but it's an excellent way to save for healthcare costs in retirement tax-free. And you can actually build that account a little bit faster because with an HSA, there's actually a limit on how much you can contribute each year. So who is eligible for a 401h, Michael?
Yeah, if you're an employer and you sponsor a defined benefit plan or a cash balance plan, you can implement a 401h, even if you haven't done that previously, into your plan. And then you can start setting aside 25% of your contributions into that 401h account.
Yep.
And then when employees retire, now the employee has to retire with your organization, but when they retire, then they're able to take dollars from that 401h account and use it to pay for medical premiums, so the Medicare side of things, their supplemental coverage. They can use it to pay for long-term care premiums or expenses. They can use it to pay for almost any medical expense that would be covered under a flexible spending account. So it's a great benefit, and you can pay for your spouse too. So that's great. You can do it for both.
Right. And we get a lot of questions about a 401h because the majority of people say, what is that? Never even heard of it. Why isn't my advisor talking to me about it? But it can be a really, really great option that if your company is not taking advantage of, and if they're eligible, you should absolutely try to implement a 401h.
And so a third way is just making sure that your 401k plan has Roth options. Roth is not quite as great as the HSA and the 401h because you're not getting a deduction up front, but you are getting to take the dollars out of those Roth 401ks in a tax-free basis. So that will help offset what those taxes are when you're retired. And the nice thing with a 401k is you're not subject to the income limitations that an individual is subjected to in being able to contribute to a Roth IRA. So the Roth 401k, you can put dollars into that, and it's a great benefit. Another way, Shannon, is life insurance, right? So let's talk a little bit how that might work.
So life insurance is a great way to pay for healthcare costs and possibly long-term care costs in retirement tax-free that a lot of people sometimes miss. And they don't realize that they can take out distributions later on that are tax-free and can be actually, again, used to pay for even healthcare premiums, Medicare premiums.
And you as an organization can create ways where you can bonus money to your employees. So they'll end up paying the tax on those dollars, but then they can use that money to contribute to a life insurance policy, and then it can grow. And then when they retire, they're able to take distributions out of that policy tax-free. So it's definitely underutilized. A lot of Fortune 500 companies provide non-qualified deferred compensation plans to help executives, but in most cases, those are taxable. What we're really talking about is creating ways for, again, you as an owner or for your executives to be able to take money out tax-free to cover what those healthcare costs are. So those are four ways. There may be some others. I mean, certainly reverse mortgages are ways that people can pay for healthcare costs. But those are some ways that you as an owner or as an organization executive, things that you can do to help your employees and key people save for healthcare costs.
We always like to say there's nothing that can derail a retirement plan worse than unexpected healthcare costs. And the reality is most people aren't planning to the extent that they should for healthcare in retirement. I know Fidelity puts out a study every year that gives kind of an average on what to expect. But if you're a higher income earner, if you're a business owner, chances are those numbers do not apply to you. You're going to pay a lot more than your average person. So that's why it's so important to plan appropriately.
That's right. And Shannon, you'll see at the bottom there's a disclaimer when you read the Fidelity report that basically talks about the fact they do not take into account means testing. So it's really important to understand that. And the inflation rate for higher incomes when it comes to means testing is about 8%. A year annually is what those have grown. When you're under that amount, which is the number under 87,000, which is what Fidelity uses, it's closer to 3%.
Really, the younger you are, the worse your problem is going to be when you get to retirement. But the good news is you may still have time to plan.
That's right. So don't get punched in the gut. Don't let this be a surprise. If you're an employer, make sure that you're helping your employees and your executives save for healthcare in a tax efficient way.
Yes, and if you're curious on what it might actually cost you, go ahead and check out the link in our description below. If you answer a couple quick questions, we will email you a pretty comprehensive report showing you how much your healthcare costs will be in retirement and how that might impact your Social Security. If you have any other questions, feel free to let us know in the comments below. We are Shannon and Michael, and we're always here to help. If you haven't already, make sure you subscribe to our YouTube channel and click the notification bell so you know when we come out with new videos.